As of Wednesday, January 28, 2026 at 5:10 p.m. Central European Time, ASML Holding NV, trading under the ticker symbol ASML on the NASDAQ, is priced at $1,454.59. This represents a significant intraday rise following the release of their fourth quarter earnings report, which has sent shockwaves through the semiconductor sector. While the broader market was bracing for a period of cooling after the massive run-ups of the last few years, ASML just shattered the glass ceiling by reporting net bookings of 13.2 billion euros. To put that in perspective, that is more than double what most analysts on Wall Street were predicting. Usually, when a company doubles expectations on a metric as critical as future orders, you see a straight line up. But what's fascinating here is the tension between these record-breaking numbers and the simultaneous announcement that the company is trimming 1,700 jobs. It is a moves-within-moves strategy that most retail investors weren't expecting to see from a company that essentially owns the keys to the future of computing. The expectation was that ASML might start to see a plateau in demand as their major customers, Intel, Samsung, and TSMC, finished their initial build-outs of high-end fabs. Instead, the reality is that the artificial intelligence infrastructure race has entered a second, much more aggressive phase. This isn't just about small upgrades anymore. It is about a total shift toward High-NA EUV lithography, the specialized machines that only ASML can produce. The massive order beat indicates that the biggest chip makers are locking in capacity for 2026 and 2027 because they are terrified of being left behind. If you are looking for investment help in this sector, you have to look past the top-line revenue and focus on these bookings. They are the ultimate leading indicator for the entire semiconductor industry. When ASML's backlog swells to nearly 39 billion euros, it tells you that the AI bubble talk is being ignored by the people actually building the hardware. They are voting with their capital, and they are voting for more expansion. The market narrative has often painted ASML as a cyclical beast, tethered to the ups and downs of consumer electronics. However, the current price action and the sheer volume of institutional activity suggest a decoupling from that old story. We are seeing a shift where ASML is being treated less like a hardware vendor and more like an essential utility for the digital age. If you want a 2-nanometer chip, you go through ASML. If you want the next generation of generative AI models to run efficiently, the path leads back to Veldhoven. This monopoly power is why you see such a premium on the stock compared to other equipment makers. While companies like Applied Materials or Lam Research are vital, they don't have the only game in town status that ASML enjoys with EUV. This reality is forcing even the most conservative fund managers to reconsider their weightings. Now, let's address the elephant in the room. Those job cuts. Why would a company at the peak of its powers, with a record order book, decide to let go of over 1,000 employees? This is where the gap between expectation and reality gets really interesting. The expectation is that job cuts signal trouble. The reality is that ASML is aggressively streamlining its operational model to protect its margins in a high-inflation environment. They are cutting the less agile parts of the business to ensure that the massive revenue expected in 2026, which they just guided to be between 34 billion and 39 billion euros, drops straight to the bottom line. It's a ruthless, professional pivot. They are signaling to the market that they aren't just going to be bigger, they are going to be leaner and more profitable. For anyone using an individual brokerage or exploring online investing, this is the kind of nuance that separates a casual trader from someone who understands the structural shifts of a global leader. Recent trading sessions have shown intense institutional accumulation, particularly from large-cap growth funds that have been rotating out of software and back into the picks and shovels of the hardware layer. We are seeing high-volume support levels forming around the $1,400 mark, which was previously a heavy resistance point. The intraday movement today, swinging from an open of $1,417 up to these current highs, shows that the buy-the-news crowd is being overwhelmed by long-term institutional buyers who are finally convinced that the 2026 growth story is real. It's a fascinating time for anyone tracking Tesla stock or Nvidia stock because ASML is the fundamental engine that allows those companies to exist in their current form. Without the lithography systems ASML provides, the roadmaps for those tech giants would simply stall. Looking at the broader macroeconomic picture, the pressure of interest rates has finally started to take a back seat to the pure industrial demand for compute. We've seen a lot of volatility in the iShares Semiconductor ETF, but ASML has managed to maintain a distinct trajectory. This is partly due to their massive €12 billion share buyback program, which they just reaffirmed. When a company is buying its own stock at these levels, it tells you they believe the current valuation is still not reflecting the true long-term earnings power. For those of you managing your own portfolios through platforms like the Robinhood app or SoFi Invest, seeing a company commit to that level of capital return while also investing record amounts into R&D is a very rare combination. It shows a level of maturity and confidence that you don't often find in the high-growth tech space. At this point, I want to hear from you. We've seen some incredible moves in the chip sector lately, and the debate is only getting more intense. Comment below how many shares of ASML you currently hold, or if you think the current valuation has finally peaked. It's a divided house right now, and I'm curious to see where you all stand on the monopoly premium that this company carries. To understand why ASML is in this position, we have to look at what they actually do. Their business model is built on a razor and razor blade strategy, though the razors in this case cost upwards of $350 million each. They sell these massive, complex lithography machines that use light to print patterns on silicon wafers. The razor blades are the service contracts, the software updates, and the specialized parts required to keep these machines running 24/7. Once an ASML machine is installed in a TSMC or Intel fab, that customer is effectively locked into the ASML ecosystem for decades. The switching costs are not just high, they are practically insurmountable. This is the ultimate moat. Competitors like Nikon or Canon still exist in the older DUV space, but when it comes to the cutting-edge EUV technology needed for the world's most advanced chips, ASML has a 100% market share. They are the bottleneck of the global economy. In previous years, there were concerns about China. The export restrictions imposed by the US and Dutch governments were expected to create a massive hole in ASML's revenue. The expectation was a significant contraction. The reality, however, has been a masterclass in market diversification. While sales of the most advanced EUV machines to China are restricted, the demand for mid-range DUV equipment for automotive and industrial applications in China has exploded. Furthermore, the push for chip sovereignty in the US and Europe, led by massive government subsidies, has created a whole new pipeline of demand. Every new fab being built in Ohio, Arizona, or Germany needs ASML machines. The company has essentially traded one growth engine for another, and the net result is a more balanced, globally distributed revenue stream. The technicals of the stock are equally compelling. We are seeing a classic cup and handle pattern forming on the weekly chart, with the breakout occurring right now on the back of this earnings report. The relative strength index is pushing into overbought territory, which might suggest a short-term breather is coming, but the underlying volume suggests that this is a good overbought, the kind where people are chasing the stock because they realize they missed the bottom. For those using more sophisticated tools like Interactive Brokers or Fidelity Brokerage, the options flow is showing a massive increase in long-term call buying, specifically targeting the 1550 and 1600 strikes for later in the year. This indicates that the smart money is positioning for a sustained move higher, not just a one-day pop. Looking ahead, the catalysts for ASML are numerous. We are moving into the High-NA the High-NA phase of production, where the newest machines will allow for even smaller transistors. These machines are even more expensive and have even higher margins. As the first of these are shipped and recognized in the revenue figures throughout 2026, the earnings per share growth could be explosive. The risk, of course, remains geopolitical.